Good evening, everyone, and welcome to the 10th consecutive episode of PIM Monthly Montage. As the nation's management mentor, last year in December, we decided that in a world where we were forced to rethink everything due to the pandemic and many of the other accompanying forces, as the nation's management mentor, we thought that it's our duty to conduct regular forums with the input, the insight, the intel from various professionals across diverse spectrums, combine it with the know-how and the knowledge of PIM as well, and share it with our learning partners as well as the wider business community of Sri Lanka. The PIM Monthly Montage was the result of that thinking. And indeed, it is a proud moment to reach the 10th consecutive episode. And today, we, as always, will be discussing a very pertinent topic, a topic that is much heavily debated, discussed, and searched upon and analyzed across so many different sectors, which is none other than the crisis of the dwindling dollars. Every day we hear about this. Every day there is some new restrictions which are brought upon. I believe even a few hours back, there was a new restriction that was brought upon as well. What does this really mean? How is it affecting and impacting the regular activities of our economy? This is what we will be discussing today, and we could not have come up with a better combo than this for today's discussion. And it is my profound honor and privilege to introduce to you the speakers for today. First, we have Mr. Senaka Kakiriwaragodage, Chief Executive Officer at NDB Capital Holdings Limited. Senaka is having his strong skills in business planning, investment banking, strategic financial management, risk management, and financial analysis. He is also guiding the strategy of companies across multiple different sectors, such as agri-products, construction materials, power, IT, and leisure as a board member. He has a very strong IT orientation and having initially launched his career as a software engineer. And he's also holding an MBA from the University of Manchester Business School of the UK. He's a fellow of CIMA UK and a CFA charter holder as well. And he's a very passionate lecturer involved in coaching. And he's also having lecturing experience across diverse qualifications. Mr. Senaka Kakiriwaragodage, I have no shame in calling you, sir, having been a student of yours as well. Absolute pleasure to welcome you to the PIM Monthly Montage.
Thanks, Narendra. Thank you.
And we, along with him today, we also have a very young, dynamic individual who is none other than Shiran Fernando. Shiran is presently the Chief Economist at Ceylon Chamber of Commerce and the Head of Economic Intelligence Unit. He's also engaged in providing policy-level support and strategic advice to the government, incorporating the views of the private sector to shape the national economic agenda. Must be a tough one on that, Shiran. And before joining the chamber, he was also the lead economist and senior product head at the Frontier Research, where he was responsible for the growth and strategic direction of the economics research division. He has been a part of numerous economic and business forums as a panelist, speaker, and a moderator, and he's also contributing to the LMD's Economic Outlook column. Shiran is also a member of CIMA, and at the same time, he's also former alumni member of PIM, having completed the executive MBA. So, Shiran, for you, it's more like return back to home. Welcome back to home, Shiran, in the form of PIM Monthly Montage.
Thanks, Narendra. Good to be here.
So, as always, I will be sharing a round of questions with each participant who will be taking a certain time and replying to that, after which, towards the end, we will have the questions available. Please do feel free to share the questions with us directly via Zoom or even directly via Facebook as comments. My first question is to Mr. Senaka Kakiriwaragodage. Mr. Senaka, how weak is our dollar reserves as at present, and how far off are we from bankruptcy? We hear this term very often, that we are losing dollars, our dollar reserves are going down. And how bad is the situation, in other words?
Thanks, Narendra, again for inviting me. Sorry. So, answering the first part of the question, how weak or how bad is the dollar reserves position? end of July 2021, month ago, maybe 2 months ago, we reached, I think, probably one of the lowest points in terms of our reserves position to about US dollars 2.8 billion. I think it is the post-war lowest levels in terms of reserve position. I think the lower point we had was in 2009, prior to that, when it was at the peak of the war. However, with Sri Lanka drawing down on this special drawing rights from IMF, about $800 million, and also the swap agreement with Bangladesh government, not the entire thing, but about $150 million came through that. So with those, I think the government numbers are not yet published, but the estimation is, as at the end of August, the reserves position could be around $3.5 billion. And if you take the remainder of the year, which is about 4 months to go for 2021, with various bilateral agreements in the pipeline with the People's Bank of China, maybe Reserve Bank of India, my estimation is probably we might end the year with about 4 billion to 5 billion, somewhere between that number of reserves position. Probably Shiran could also make a comment on that when he speaks. And then connecting that to the bankruptcy question, bankruptcies, whether it's an individual or a corporate or a country for that matter, that you are unable to meet your debt obligations. So other side of the equation, this is like a debt servicing ratio for a company. On the numerator, you have the cash flow generation and the reserves you have. On the denominator is how much you need to pay. So that number, I think we'll focus only on the foreign currency debt, yes, because rupee debt is something the government could manage. I mean, not entirely. It's not a such an easy thing, but it is largely within the government's control, because even you can print money to address that in the short run.
Yeah. But what you're saying is it's the lesser of the evil.
That's correct. That's correct. And it is not a luxury that you have with regard to foreign currency debt. So on average, we have about 4.5 billion, anywhere between 4.3 billion going up to $5 billion equivalent of debt for the next 4 years, 2022, 3, 4, and 5. So we have about 4.5 billion debt payments. And as I said, my estimation is we might end the year with about $4 to $5 billion reserves. So, I mean, let's all hope, let's not go to that bankruptcy situation as a country, as citizens, but whether we will go there and if it will happen depends on what we do though with those two numbers. It's a mathematical equation, isn't it? What will happen to that reserves? How fast we'll deplete that, or how we'll add to that number? And what will happen to that debt number? Can we restructure that? Can we change that number? Can we move it from this year to next year? So in other words, could we restructure that debt? So I think it will all depend on the strategies we take, whether we get to that bankruptcy, if or when. I think that question will largely depend on what we do to those two numbers. And look, I think what we can do at this moment is some sort of a scenario analysis. I think on the extreme pessimism, we could think about a scenario that reserves portion could deplete further from where we are. Maybe our trade deficits widen, no new capital flows come in. So it's a pessimistic scenario, and nothing we can do for the debt number also. Then it has to happen sometime during the next year. But if we can do something about it, if you are optimistic about it, we grow from that 4 billion odd number, we add more dollars into that reserves position. And if you can do something with the denominator also, if we could reschedule, restructure that debt, probably we could, I'll use that word, we can kick the can down the road further until probably other things get better. Yeah.
Nice way of putting it, Mr. Senaka. And yes, indeed, I think as you very correctly said, it's about how well we balance the reserves we have, because it's not that we have got it due to trade or anything. That is also borrowed money, which eventually will lead to more debt payments. I like how you put it at the end. I'll now move on into Shiran. Shiran, now your forte is economics. My question to you is, how did we get to this point where we are? Some people say that this is the lack of tourism, due to the lack of funds of tourism, that we have ended up in a situation like this where the tourism dollars are not coming in. Is it just that, or is it that the whole pandemic and the lack of tourism truly exposed a more fundamental issue with the structure of our economy?
Thanks, Arindu. So I think I'll start off the answer with what Seneca just ended with. I think kicking the can down the road. I think for a long time we've been doing that and constantly every year going to the market and raising external debt just to kind of roll over and refinance our existing debt. But what happened, I think, pre-pandemic is useful context to set in and then understand kind of how we got here. I think pre-pandemic, 2019, as the new government came in, there was a slew of incentives, tax reductions, all of that took place to really gear up the economy. And we were looking, there was no secret, even then we knew between 2020 to 25, 26, we did have consistently about 4 billion to 4.5 to 5 billion in certain years in terms of debt that we needed to repay. So those metrics were, I think, clearly kind of outlined as well. And I think the focus of government was to really get growth back on track. But unfortunately, the pandemic happened. But what the pandemic really did was spotlight countries like Sri Lanka, which did badly on these indicators, which Seneca alluded to, where our debt to GDP ratio is low, how much our revenue to GDP is, how much of interest, how much of our interest payments are as a percentage of our tax revenue. So all of those indicators, which pre-pandemic did not look great compared to our rated peers. I think that's important to understand, kind of came to light. And because of that and the pandemic expectation, I think that became a snowball effect. We saw the rating agencies downgrade us last year, for the downgrade this year as well. And because of that, all the investors, in particular the international investors, took a very risk-averse view to Sri Lanka, and basically, it demanded a higher premium. And as a result, we've seen yields, the interest rates for our dollar debt, the international sovereign bonds, both on the short end and the long end, being in double digits for the last, I would say 12 to 18 months consistently. So we've been basically locked out of the international capital market because of these two reasons: the downgrade plus the yields being too high. So we can't go back to our previous strategy of always raising debt whenever we needed to refinance and manage the deficit. So we are exposed in that situation, and I think that's kind of where we've been. I think the recent panic, especially over the last few weeks and with the dollar fluctuation, I think is really everyone was expecting, especially with the July 27th international sovereign bond of $1 billion. Post that payment, maybe things will get better, because I think prior to that, the central bank was not really intervening in the market, trying to hold back its dollars, preserve the dollars to repay that debt. And they did the same, I think, even October last year when we paid $1 billion, but we didn't raise any additional debt to pay that. So we've been consistently using these reserves. And I think the big trigger point was the recent surge that we've seen in the pandemic with the cases going up, because I think the expectation prior to July was maybe by September, October, tourism will begin in some form or shape. And because of the numbers picking up, in particular in July and August, I think that expectation has certainly diminished. Maybe it might be towards the end of the year or even early next year. It depends really on how the numbers reduce. But I think that has been a key trigger, especially in the recent rupee matters, because tourism was, at least some level of inflows was expected to kind of ease some of the concerns. And also what we've seen, especially looking at June and July, is a slowdown in remittances. So banks typically, get these remittances in, get their exporter proceeds and match it up with the importer proceeds. When you have a slowdown in remittances as well, that doesn't really help. So I think a combination of all these factors and a few trigger points Definitely the pandemic being the larger trigger point, but also I think the impact on tourism, the prolonged impact on tourism, and the slowdown in remittances have caused this, I would say, crisis of confidence in where the rupee is going. Where the rupee is going.
It's a very good perspective you brought in there, Sharon. As you said, the brutal honesty, the fact that what we've been doing so far is exactly what we should not have been doing. But as you said, a lot of factors not really working well in our favor, and tourism was expected to pick up this year. But then again, the Delta variant has made us think otherwise. And as you said, so many forces not really working in our favor there. Thank you for those thoughts. I now shift back to Senaka. Senaka, just to put things into the right frame here. Now, you did clearly mention that bankruptcy is not something that is which is ideally close to us now, but it's all about how well we can avoid going to that point. But I want to take things in a different direction here. Now, since you did explain what bankruptcy means and what it really does to a country, we see a lot of negative sentiments being shared about Sri Lanka on a daily basis by so many media outlets. Now, for example, if you look at Gravitas of India, there's almost like a weekly video or two clearly showing, I saw a recent one saying Chinese debt starves the Sri Lankans, right? That Sri Lankans are starving due to China. These are the exact words that they had used. And I'm quite sure there are so much more other different articles which are being shared across so much of other international media. This not so great economic outlook, I think that's the best way we can put it without being too pessimistic. What does it really do to us, to our economy in a more global context like today? And especially, what is the impact on financial markets of Sri Lanka due to this? Because I don't think once people see this, any foreign investor, any foreign lender would even want to be a part of the action here.
Yes, Tarendu, as you know, how the markets behave is largely down to sentiment as well, isn't it? Sometimes not necessarily the facts or the economics, but the behavioral financing part or the sentiment plays a crucial role in how the markets operate. In fact, if you take last couple of years, continuously we have seen foreign investors exiting our markets, mainly capital markets. If you take Colombo Stock Exchange, for an example, I think last year, 2020, the average net outflows would have been about equivalent to 50 billion rupees. That's about maybe $250 million. I think this year so far, till about June, it was about, again, outflow of $125 million. So that's quite a large number. Probably we are getting to the same number as of last year. I think it's about 30 billion plus end of July, that number. So, I mean, continuously foreigners have been exiting, but I would say, I mean, look, let's leave the news aspect aside. If you anticipate the LKR to depreciate, Sri Lankan rupee to depreciate, as a foreign investor, you will make a negative return just on the currency depreciation as well, because your assets are in rupees. When you convert that to dollars, you will get a lesser number if the rupee is depreciating. So there's an economic reason behind this behavior also. So I think the news, I mean, there can be other elements to that news, maybe political, maybe social angle to that. So which will definitely dent the confidence of the markets. So when the market confidence is broken, I think there'll be a lot of negative repercussions. And what we are, as Shiran said, we have not been able to raise dollars in terms of fulfilling these refinancing obligations. I mean, largely down to the credit downgrades as well. These downgrades also will communicate, look, there's a default risk, and maybe default risk, which is high as far as the country is concerned. So any investor will take a very cautious approach before you invest. And we have seen that across the markets. I mean, our bond exposure is much lower now. Most of the guys left Sri Lanka in the bond markets, when I say bond markets, treasury bonds in 2018, 2019. And a lot of equity investors have been leaving in 2020 and 2021. So that's the scenario. So I think what we need to do as a country is to infuse a little bit of confidence back to the market. and how we could do that. So I think we should probably give a signal. Maybe dollar depreciation has happened. So we know, oh, look, say if it is 220, this is the bottom. And from that point onwards, we start building upon it. So you put behind yourself the doubt of depreciation. So I think it's important to kickstart the confidence back and infuse that the positive sentiment to the market. I think probably sooner than later, given where we are.
Some interesting thoughts there, and as you very correctly said, some of these economic news always, I mean, news as it is always has a political and social angle, especially when it comes to these global reporting. Thank you for those thoughts. Coming back to Shiran. Shiran, now we see lots of import controls being set, especially to curb the imports. What they say is they want to cut down on the outflow of the dollars. But from a more holistic economic perspective, Shiran, is this something that is truly pragmatic? Because, for example, we all know Sri Lanka is not the greatest of value-adding destination. Most of the time, and even our exports require a serious, significant level of imports. And if you take some of our industries like tourism, like if when the tourists come in, for them to consume, you need all these imported alcohols, imported food items, etc. So the real question is it something pragmatic, these import controls, number one? Number two, what about the success rate of it? Has it truly been a success? Because we've seen from last year, the import controls have been there, but the results, the numbers are telling us a different story. Perhaps as an economist with a more deep analysis and an idea of this, you can demystify the situation for us, Shira.
Thanks, Narindu. So if you look at the imports for the first half of 2021 compared to even last year, it's up by about 2.3 billion. It's even higher than what it was in 2019. So we're clearly, from an import perspective, higher than pre-pandemic. What has been really driving it this year, I think if you look at the breakdown of it, the biggest item has been fuel. That's 544 million out of that 2.3 billion. So when almost close to 20% of it is driven by fuel, which is driven obviously by global oil prices. And that last year kind of bottomed out around $20 a barrel and then has gradually, gone up to 60, certain times peaking about 70, 75, now around $70 a barrel. So that steep rise, I think, has been a key driver of one of our import items. If you look at the next item, which is quite high, is textile and textile articles, which is, I think, around 385 million. Now, that's a reflection of, because a lot of it is input for exports and apparel exports. That's a reflection of the pickup in apparel exports, which are up about 500 million or more in the first half of this year as well. Then we look at some of the other products. You can see, and what's not sort of maybe getting too much of highlights is actually how high global commodity prices are, especially and global food prices as well. It could range from grains, it could range from even sugar to palm oil. All these are at quite high levels compared to last year. A lot of those reasons are because of the kind of the swift recovery that the global economy has seen, especially in certain developed markets, and also a factor, I think, of the higher shipping costs as well, and also some of the pandemic related disruptions where supply can't really meet the demand, and that's causing kind of an artificial increase in some of these prices. So a lot of those have meant some of these intermediate goods like chemical products, base metals, all of those have gone up. And also with, I think, the resumption of economy and construction and things like that, and some of the key projects, I think items like building materials, transport equipment, some of those have also gone up. So it's not really a reflection. I would say 70 to 80% probably is more to do with the resumption of the economy compared to last year, so from a low base, and also where global commodity prices are, because we are dependent on these and we don't have a say. For example, if you look at oil or fuel, or if you look at other factors as well, it's driven by those markets. Of course, the import regulations, I think, especially in the middle of last year, especially in April and also July, they were restrictive. But slowly as the year went on in 2020, a lot of the intermediate goods which are needed for exports and also for domestic manufacturing, a lot of those were loosened, and we saw more import regulations, especially towards the end of the year, only for consumption, some of the consumption related goods, in particular vehicles, and for some of the investment goods. But a lot of those have actually now gone into what we call credit terms of 90 days and 180 days. So actually some of these factors could be some of the items that we even ordered last year actually coming into the import books and payments this year. And the banks really giving those. So some of those could be those import orders that we placed last year actually coming maybe in the first 3 months, first 4 months, depending on the credit terms as well. So it's not necessarily, I think the import controls, it's difficult to say whether it succeeded. Of course, it doesn't work in the long run. And I think a lot of countries have seen that how it hasn't really worked in, and it's also not favorable for exports. But I think it's good to just understand it in the context of not only Sri Lanka, but in terms of where things are globally as well for these commodities.
Yes, you very correctly said a lot of some of the controls taken have not really shown to be having much of an impact. And I mean, there has been a lot of wrong economic assumptions made by so many different parties, not just Sri Lanka, isn't it? I mean, if you look at, for example, if you take the supply chain chock-a-block, which we see globally, it all boils down to a lot of companies even thinking, look, people will be at home and will not be spending much. Whereas when people were at home, they started spending more on their home items, etc. And it's that backlog of orders which we now see really jamming all the supply lines. I like some of the ideas you shared there as well, Shiran. And moving back to Senaka, if we look at the stock market, now I know this is one aspect that you are regularly following on a very consistent basis. You are involved, you are there in the action, what we call with you are not just in a front row seat, you're actually in the ring. So I believe you are the right person to ask this question. If we see the performance of the stock market, it's at a sky high level. I mean, it's probably unprecedented. It's showing a tremendous amount of returns. But here we have an economy with a lot of fundamentals wrong, but stock market is doing fantastically well. This is a little bit of a, not little bit, I would say this is quite a mind-boggling fact for many individuals. Is it a case of the CSE, the Colombo Stock Exchange, kind of being decoupled from the reality of our economy? Or is this how markets work during volatile times? Share with us your thoughts.
Tarindu, I think similar behavior in stock markets are seen worldwide, whether it is S&P 500 or European stock exchanges or even India for that matter. Most of the markets are recording all-time high numbers. I think the main driving factor of this stock market behaviors around the world has been low interest rates. Due to the pandemic situation, most of the governments around the world cut their interest rates. I mean, look, if you take the Sri Lankan situation, we are probably at all-time low interest rates as far as the rates are concerned. So generally, there's a migration of capital from fixed income to other asset classes, because say, if I was living on my interest income, I mean, you can attribute to an example of say a pensioner who are living out of interest income, or anyone for that matter, your income in Sri Lanka probably would have halved over the last 18 months or so. Maybe fixed deposit rates of about double-digit 12% down to 5 to 6%. So there's this natural capital migration out to other asset classes. So not only equity, but even asset classes like real estate probably would have been beneficiaries of this. So that is one aspect. And also, if you look at probably the situation in Sri Lanka in particular, we might be probably heading into negative real rates kind of scenario. So what do you mean by negative real rates? Ideally, the interest rate in the society should be higher than inflation. So as an investor, as a saver, you get something in the positive. But if interest rates are lower than inflation, it's kind of savers losers outcome, because you are earning what we call negative real rates. So if that phenomenon continues,
Senaka, I think we lost you for a bit there. Shiran, I believe you can hear me.
Yes, I can hear you. I think we lost Senaka.
Just for a bit, isn't it? Yeah, I'm sure. Okay. Senaka, I believe you are back with us.
Sorry, I lost for a minute. Let me continue.
No, I think where we lost you was where you explained what negative interest rates were, and you said if that phenomenon continues.
Yeah. So if that phenomenon continues, the corporates will benefit, because inflation means price of goods and services going up, which means the company's revenues will go up. On one hand, there's a lower cost of capital effect because of the low interest rates. So that justifies to a certain extent why the stock prices are going up in anticipation of better profitability in the future. I think in Sri Lankan case, there's another probably unique situation given the economic volatile scenario we are in. That is, particularly if there are corporates with dollarized income. And I think the problem of the developed world, like Europe and USA at this moment, is how to deal with inflation. I think those economies are starting to feel the heat of inflation coming in. So what do you mean by an export company? Probably your fortunes are largely reflected on those markets. Say if you are exporting to US or to Europe. And also in a peculiar situation like in Sri Lanka, the investors also might look for a bit of a safe haven. And if your income is driven by dollar earnings, and I think it makes sense to diversify your assets into dollarized assets, right? Or real estate for that matter. So there can be certain assets within the equity market which might even do better, particularly if you're having, say, dollar income earnings, or maybe some real assets like real estate companies. So I think even if you study some of the economies which have gone through this kind of very difficult periods, maybe a very recent example being Lebanon, I think even in their equity markets, probably you might see a couple of sectors like exports or real estate, which have been doing well. So I would attribute this to maybe two broad factors. One, the low interest rate scenario, which is a bit of a global scenario, which explains why equity markets have been behaving like this. Two, within that, there may be some special asset classes or sectors that might do well. I mean, for example, if we expect rupee to devalue significantly, and I'm sure the corporates with some dollar earnings will get the benefit. So I would put both these factors into it. Within that, as you said, there may be inexplicable or unexplainable behavior with certain stock prices, but that is something we have seen throughout in Sri Lankan market. I would just put it down to being a very, very small market, lack of depth and lack of liquidity. And it's easy to manipulate if I want to use that word.
Really appreciate the bluntness there and laying it out all on the table for us. My next question is to Shiran, but once Shiran has answered it, Senaka, I don't mind definitely you chipping in here as well, because this is related somewhat with the banking sector as well. And after which, of course, we will go in for getting both of your opinions on what solutions are there, because everyone is talking. When I shared the idea that we are going to have a workshop on this, everyone said, everyone is talking about the problem. Why not solutions? Who can talk about the solutions? So we are going to come to that after this question and perhaps take about 15 minutes more and answer the questions that our audience will have as well. Shiran, let's talk about the short and medium term outlook, at least until, let's say, until end of 2022. These artificial controls of the exchange rate, is it something that is truly practical and viable? Because let's face it now, I believe yesterday and today, the rates have been artificially brought down to about 204, 202 range. But the truth is that there are no banks that will give you the dollars at that rate. At least that's the common sentiment. Okay, the rate is there, but they are not providing the dollars at that rate. And I believe the CBSL has given a strong message to the banks and said stick to this rate. But aren't we effectively living in an economy with what some people call 3 different exchange rates? State banks having one rate, the private sector banks were having another rate, and if you look at some of the money exchanges, they were going at about 225, 230 range, which is somewhat of an indication, at least where things are. And I would like to say that maybe we have 4 exchange rates, because if you look at the areas of crypto markets where people are buying cryptocurrency, as you know, there is a currency called USDT, which is a very famous currency, almost equivalent. It's supposed to be one USDT is supposed to be equivalent to about $1. Whereas last week it was going at about 230. Yesterday I saw it's they are selling on average a USDT is being sold on peer-to-peer trading in the crypto markets at about 245, 246, even 247. So what exactly are we looking at here in terms of this artificial controls of exchange rate?
Thanks, Saidu. So I think the reason you mentioned those 3 rates, probably why yesterday you had the letter from the governor going to the CEOs of the bank saying, stick to this one rate. But I think there is a broad issue in terms of really giving a bit more confidence to the market. I think there is dollars in the market. I think exporters, deposits, and some of those are there. But it's really how can they get the assurance to really convert it and bring it to the market so that they can really match whatever the banks have in terms of import LCs and things like that. So I think it's usually difficult to hold it at a particular rate, especially if the market is not really geared towards that way. And usually, historically, it's been shown how markets have how markets have won in this, not won, but basically been able to convince that these fixed rates would not work. So as in the real question is, what rate would a lot of these exporters be comfortable in really bringing to the market? Whether is it 210, is it 215, is it 205? And I think that's something that has to be sort of determined. And I think that is where I think maybe 6-8 months, I've forgotten when it was removed, but the forward market was essentially removed in the last 6 to 8 months. So I think we need to bring that back up, because that's where, as similar to the stock market where you have price discovery, that's where you have the forex discovery, and that will also bring back a little bit of business planning back to the exporter. So it's not all panic. You don't have to worry too much, because there is a 1 month forward, there is a 3 month forward. Maybe initially start with the 1 month, 3 months, because maybe 6-12 months might be a bit difficult to forecast at the present point. So we might want to bring some of those instruments we had back to give a bit more assurance to the spot. And then I think some of these other measures will come in. And I think a lot of the other inflows that we're expecting, I think, as Seneka mentioned, we've got the IMF SDR allocation increase into our reserves. We've got a bit of the Bangladesh swap. I think the China Development Bank, probably those inflows will also come. But the market intensely wants to know what's more. Because what we've simply done, I think the August numbers show that reserves are only back to about 3.55 billion. So we're not even back to where we were prior to the sovereign bond. But how can we get to about 4 billion, 5 billion, so that there is a bit of a comfort factor, there's a bit more confidence. And I think those few factors plus will also give more confidence to remittances, to those who are sending remittances. Because I think part of the reason maybe why remittances are slowing down, part of it is also base effects, because I think June and July last year were at a significant high level. I think June hit about 700 million, which was kind of that pent up demand when the Middle Eastern market was closed during the first wave. But I think the rest of it is migrant workers holding back their dollars, thinking, okay, if I send it in a few months more, I can get a higher rate. So why do I want to send it now? So I think a few of those measures can inspire confidence, which will then have a rollover impact. So then this doesn't have to be an artificial rate. And I think this is a discussion. I know the central bank, the bankers always have this conversation, but I think we need to kind of move towards that. And I think also articulation of the clear I know we're jumping the gun in terms of solutions, but I think it's good to bring it into your question.
Absolutely, yes.
Because part of the solution is also understanding what our debt numbers are properly. What is really going out externally next year? A lot of people put those numbers, rating agencies put out this number of, there's 26 billion between now and 2026 that we need to refinance. So part of that is also, I think, building a bit more credibility with those numbers and how we're going to face it. So I think it's not rocket science. I think it's mainly confidence building measures that are really required.
Senaka, your thoughts quickly for about 2 minutes before we start discussing the solutions in more detail.
I think it's absolutely connected to the solutions as well. I think the last thing we could afford at this moment is not to have the export money and remittance money coming into Sri Lanka, because I think any equation we are building, that will be the base, right? Assumption is we will continue with, say, roughly about ₹1 billion worth of exports per month and about 500 million worth of remittances per month. So that I would say is the starting point. So I think one worst thing that could happen with this kind of controls is that we may not get that money even. So we cannot afford further dent in trade deficit, current account deficit. So I think no matter what we do, it's essential that we give that confidence to the exporters as well as the remittances, that we can send the money to Sri Lanka, we are getting the right price for that. If that confidence is brought, probably we will have a problem that we don't even anticipate now. So we need to go back and fill that hole also, which will be quite a difficult exercise. So I think it's very much connected to the solution. We'll talk about it maybe later. I think it's important that we correct this long-term trade deficit problem in the Sri Lankan economy. I mean, you can't run an economy with maybe 10 billion exports and 20 billion imports. That has been the rough numbers for so many years, past so many years. So I think we need to correct that. And the only way we could correct, I mean, controls could be one mechanism, which is not a very long-lasting mechanism in my view. So it has to be a market mechanism which drives this behavior. So exchange rate is obviously one tool. With a better exchange rate, imports will get discouraged and maybe exporters will get encouraged. And also people will look at import substitution to the extent that is possible. So it's very important we narrow that gap, and only it will happen with little more confidence to the exporters and even remittances.
All right. Okay. Before we start taking up the questions from the participants, a quick round on solutions. Now we can talk about economic policy, we can talk about economic direction, etc. But end of the day, there are businesses, there are entrepreneurs, business decision makers who are running the show, who are running, I would say, majority of the economy of Sri Lanka. Gentlemen, what would your solutions be? Because even the exporters, as I mentioned earlier, they are dependent on the imported raw material, and now some of them are struggling to really even open LCs and even arrange payments for those. What is your solution to any importer or any business that is struggling with these restrictions? What is your advice? I know this is a very open-ended area, and I believe there's a lot of issues to be discussed here, but in your thoughts, what can these businesses do? Senaka, we'll go with you first.
Right. Look, Tarindu, I think the problem is a little big. I don't know whether one individual or individual entity could find a solution probably as an importer. Look, I think probably, I mean, what the market tells is there are certain almost barter equivalent systems happening now, where importers collaborate with exporters and you exchange your dollars for your export needs to match the importers' needs. But I don't think they are very sustainable solutions, because how long you can do that, and it will be a very inefficient way of doing things, and your energy will be wasted rather than doing business to find that counterparty and at what price. So the bargaining powers will be very, very artificial, depending on.
To me, correct me if I'm wrong, it sounds to me like more like a step backward as well, isn't it?
Absolutely. So that's what I'm saying. I don't think it is a sustainable solution. So I think it's about finding that bigger solution, macro solution as a country, as a nation, as an economy. I think we need to probably focus on that. Individually, I would say structurally, probably importers have to reduce their volumes. I think there's no question about it. And some level of import substitution to the extent that is possible is important. And I've seen, in fact, some businesses moving in the direction. Example, it's a pharmaceutical, right? Is a good example. Most of the companies which were importing pharma is getting into a little bit of pharma manufacturing. So it'll reduce the net outflows as far as imports are concerned. But again, I mean, economically, it may not be the most correct thing to do. I mean, we know there's a concept of comparative advantage. We can't do everything being such a small country. So that's what I would use the word to the extent that is possible until we probably come out of it. But it's important to find that bigger solutions, the macro solutions where how do we get out of this currency crisis, Taridu? We can talk about it.
All right. Thank you for those thoughts. Shiran, solutions, the need of the hour.
Sure. So as I think Seneka mentioned, it's difficult for probably individual companies because we don't produce dollars here, which you need. It's mainly rupees that we get. So I think what can the importers do? I think really if the confidence does come back in, I think even if you look at some of our imported items at the start of this year, I think maybe a bit of it is imported in excess of maybe what the demand is, simply because you feel either there will be some level of restriction put on these items, you can't really open LCs maybe towards the end of the year, and a multitude of those reasons. So I think what I think really will matter will be not even importing too much at this point, but making do kind of with what is there and kind of making those estimates at an individual level as well. There are, as Seneka mentioned, there are industries which now can have a bit more of a domestic flavor. I think pharmaceutical is the key example of how even with the pandemic, it exposed how countries should have at least a good base of pharmaceutical manufacturing, so that at least you can't be self-sufficient in a lot of things. I think a lot of the generic drugs, for example, you can't manufacture. You can manufacture, but the market is not enough. So you have to have an export flavor towards a lot of this. There is also, I think, especially when if you look at apparel, the apparel industry, in a good year, we'll get about 5.5 billion in exports, but I think we import between 2 to 2.5 billion in terms of imports. Not all of it is intermediate goods for exports, but a lot of it is the yarn and the cotton and things like that. So I think at least from a macro point of view, I think there is the idea to move manufacture those more in Sri Lanka. So I think the Rubber Park in the Eastern Province is one example, but can it be done more organically within some of the companies who are already exposed in this industry? Because that will also really mean even higher value in terms of exports even to the EU because of the rules of origin criteria and things like that, which doesn't enable us to really enjoy some of the benefits that the EU GSP Plus has, simply because we import a lot of these materials and there is not enough of local value addition to be captured. So I think there are pockets at an industry level that we can look at, and I think there are those opportunities to change strategies. But I think it's a macro mix that is really needed for. So historically, I think if in kind of these crises, it's really looking for what are your alternatives. So if you maintain a current account deficit year on year between 1 to 2 billion, on top of that you have debt outflows of about 4 to 5 billion, which we have. You need to find 5 to 6 billion each year. And as I said earlier, we've historically gone into the market. We've done that in the last decade. That tap has almost closed, and now you need to find other avenues. So the other avenues have been FDI. I think that's a key part of it. A lot of the FDI that we've got post-war or post-civil conflict has been more infrastructure-led. But can we get more into some of these kind of export manufacturing? But for even some of these FDI to come in, the investors need a bit more assurances on the currency and things like that. So that's also a bit of a weighted approach. The other is really tapping into the existing bilateral and multilateral players. See, we've done well in the last, not done well, we've managed to kind of refinance our debt, external debt, because of the inflows that we've got from India, from China, and then recently from Bangladesh. So I think to some level, we are playing our geostrategic card in that sense of getting some financial benefits in these near-term swaps and loans as well. So can those be leveraged a bit more and kind of be looked at even more? The other ones is the incremental part. Can services, in particular, services like IT, maritime in particular, I think the East Country Terminal, the West Country Terminal, those are key projects which have stalled in the last 5-6 years. Now those are slowly taking off. Can some of those bring in a bit more revenue? And of course, I saw a comment coming in, the perennial question of IMF, whether
is it inevitable?
Yeah. So I think if we've had 16 programs, a lot of them haven't really finished as well. But I think it's that because of our debt, because our debt is primarily owned by Western economies on that side, I think, and they need reassurances, and the rating agencies need reassurances, and I think that's what a typical IMF program generally provides, more than the money. So I think that's what it is. But I think what some of the ideologies in terms of flexible currency, higher interest rates, cut down in public expenditure, increased tax rates. I think 3 or 4 of those we've already increased our interest rates. We've taken that hike. I think that was a good move by the central bank. That leaves some of the pressure. They've also put a cap on the dollar deposits. So some of those measures are in that direction. Already you've heard the finance minister talking about cuts in public expenditure and curtailing. That's good in the near term, not great for growth, because you cut out public investment that might facilitate growth. The other question is on the tax rates. Will we see some level of change in the budget? Though we've been told, that there will be a continuity in tax policy. But can there be other ways in which we increase tax revenue by better tax collection, better tax administration, going back to things like withholding tax and things like that, which worked, which had historically worked, and we kind of removed in the last 18 to 24 months. So I think it's not as scary as we've had previously. So I think a lot of those measures will be done, and even the fuel price hike, I think that's something more market driven. We took that decision, but can we continuously do that? And while we do whatever is imported and commodity related, and we do take the hike, I think, can we then supplement that with kind of a targeted program for those for the low income and the other masses who are kind of disenfranchised, right? So I think we need to think around those things rather than thinking, the IMF themselves will be the end solution. It will be just a confidence building factor, but still the hard steps will be needed to take. And I think that's the discussion that we need kind of the policymakers to be also talking about.
Shiran, I think you touched upon some of the questions raised by our audience today as well. Thank you for that. Senator, there is one question I would like to share with you that has been shared with us by Senavi Ratnakure, which is the reduction of interest rates on some of the NRFC deposits. Have we seen a significant impact on our remittances due to that?
I think the reduction of remittances largely is due to anticipation of currency depreciation, as we mentioned earlier. I don't think interest rate would have played a big part, because globally anyway, I don't think anywhere else you would have got a bigger interest income for a dollar deposit. So I would say it's largely due to whether you convert it today or you convert it later, so whether you bring the money later. So I don't think with regard to remittances, interest rate would have played that significant role, in my opinion.
Okay.
If you allow me, just add one thing, I think Shiran, covered it very well for the previous question. One other solution I would like to add probably is some form of asset sale because the market needs quick solutions given the current situation. So I think probably you need to show up that reserves position by a couple of $1 billion. I think it will infuse a lot of confidence to the market. So I think asset sale is something probably, I mean, maybe not the politically most preferred solution, but I guess you might need to do it. Anyway, even if you go for IMF kind of solution, some form of asset sale in a different form, maybe say privatization form, it may come. I think these are long overdue reforms in the economy because, I mean, the more public assets you carry, eventually they may turn up to be public liabilities, but eat up into tax reserves, which will create more longer term issues for the economy.
Yes, gentlemen, there's a combination of questions which nicely complement each other, which I will share with you. There's one question that was raised asking, why are we not starting more export revenue generating business ventures in this country? And then there's another similar question. I think there are two different people, but it went nicely hand in hand, where it said, we are always talking about export, but what about the question whether our exports are truly globally competitive? Because we are no longer just competing with the likes of, China and India. Today, even China and India is competing heavily with Vietnam and so many other tiger economies of Asia, and even Bangladesh for that matter, which is today only second to China in terms of apparel exports. What is your answer to this? How competitive are we as an export destination? I'll go with Senaka first.
So in my view, Tarindu, our export strategy should revolve largely around services, is what I think. And probably, I mean, tourism is, of course, one example. But again, I don't think we've been able to do what we could have done, even in the better times. So I think it has been largely just hotels and maybe a little bit of culture, and that's it, right? But in terms of more activities, I think, look, we've been talking about casinos for a long while. But I think if you want to properly build the industry, you might need to do those things because customer or the traveler might expect those elements. And IT BPO is, I think we have this $5 billion objective, but I think we have been probably achieving a lot below par in my view. But I think it's important to back it by government policy as well, because if you take other countries, you give a lot of concessions to exporters, whether it could be rebates and tax exemptions and also infrastructural facilities. I don't think we have a focused energy in terms of promoting exports. And also, I think even the red tapes, I mean, it may not be too much of an issue for established companies, but if you take new entrepreneurs coming into business, let's say a small exporter, I think navigating the customs, the inland revenue, I'm sure that will add a lot of burden to these operators. I think you need to ask someone who operates at that level, at the bottom tier of pyramid of businesses. I guess doing business is not easy. And again, it is connected to the normal parameters we want to improve on, ease of doing business, how fast you can open a company, tax file, getting even simple things like utility connection. And the more time it takes, I think you discourage entrepreneurs, not only exporters, generally entrepreneurs. So I think we need to have a marked improvement in most of those ecosystem, I would say.
Right. Shiran, your thoughts. Are we globally competitive when it comes to exports? If not, what would be our strategy?
Yeah. So what Senaka highlighted are some of the issues at the border, which are kind of detrimental to exporters really getting off their feet and really exploring export markets, because there are challenges. If you look at export into a country like India, each state is unique. Each state has its different laws, regulations, even ports sometimes have a lot of non-tariff barriers and even tariff-related issues. So if you have more domestic-related issues and then issues that prevent you from exporting, then really surviving in those export markets make it difficult. But I think what the likes of our apparel exports, what the likes of our cinnamon exports, what the like of even our seafood and rubber, especially certain segments that we're in rubber, is our market on the merchandise goods side is the niche segment. And I think that's where we need to go more on. So obviously you can increase more or get more our traditional ones like apparel, tea, a few others. But can we, especially on the manufacturing side, benefit from not doing the whole product, but doing parts of a product or component manufacturing? And I think that's where countries like Vietnam have really taken off. Vietnam is unique because I think a lot of factors have fallen in their favor. The population size, the number of youth, the close proximity to China, the China plus one strategy, then the diversification with the US-China trade war. All of those have fundamentally galvanized them. Plus, I think
you're saying they were in the right place at the right time.
Right place at the right time. And also, I think they had an anchor tenant, which was Samsung, which came and set up there. And then that was a leading signal for the others to come. So can we attract a big player to come in? And I think right now, Pakistan, for example, I think have got Samsung to come in and do a manufacturing. Bangladesh has got another player to come in. So even within the region, things are changing and we could even be left behind from that sense. Those dynamics and their macro situation is not is not too dissimilar to us. Of course, they have their own dynamics. Obviously, Bangladesh has a more secure currency and things like that because of how dominant apparel exports is. But those countries, despite not ranking the best in the ease of doing business, despite not doing most, on some of these key indicators which a lot of investors look at, are attracting some of these big boys to come and set up. So on the good side, I think those are the opportunities which are trying, kind of too hard. And I think some of our exports, which are around $200-300 million right now, exports like seafood, I think have the potential to get to that 501 billion mark. And I think it's a bit more, right. I think we're seeing that especially with seafood right now doing really well, both in terms of its export numbers and some of the key destinations as well. So there are a lot of opportunities. On the services side, as Seneka mentioned, yes, the IT BPM sector, I think, is the key. And there as well, I think we've been lucky enough to attract a lot of businesses out of India, in potentially an India plus one strategy. Them setting up shop, diversifying their risk out of kind of having too much of maybe offices or presence in India, having a kind of shop there. But even there, it's a case of on the services, do we want more product companies or do we want more kind of service oriented, not backend, but kind of servicing organizations as well. So I think figuring out that mix and really attracting them will be key. And of course, I think a lot has been talked about the port city, but really, can that really now galvanize and attract a few key investments in as well?
Gentlemen, since we are in fact done with the time allocated as well, I would like to conclude the session giving both of you 2 minutes each to address one of the key issues right now, which is brain drain. I believe Canada has received more than 600,000. I think soon it might be having more citizens than some of the provinces of this country. But they received more than 600,000 applications, clearly indicating that people are looking at migrating, and this is clearly having a big impact on the labor economic resource of Sri Lanka. Your thoughts on this and what needs to change for this trend to really reverse? I could allocate 2 minutes for both of you just to share some concluding remarks on this thought, and we could wind up with that. We'll go with Seneka first.
So I think it's important to give particularly the young educated population hope, right? It's important because one challenge, if you think about from an individual point of view, for you to come to a certain state of life, maybe building a house, owning a car, which could probably cost you entire life as per the current economics here. So it's important that you give some sort of incentivization. I mean, while you give some facilities to certain bureaucrats and maybe even politicians, and could you have a mechanism? If you have been in a profession for say 10 years, could you get certain duty concession in terms of owning some of these assets? Because it's important to retain these people because they will be the key contributors to the economic growth. Otherwise, we know that we have aging population. On top of it, even the more active ones to leave, that will be a big problem. I think I would start with probably education reforms. Because again, if you go back and look at what we are teaching, particularly at university level, still probably 50% of the graduates could be coming from, I mean, not to have a degradation on that, but say arts streams, whether it is the market demand. But if you can train them in a more demand qualification, maybe STEM qualifications or even certain vocational qualifications, I think they will be able to use those skills better, and also it will improve the country's competitiveness, and which will enable us to probably attract more businesses or more trading opportunities with rest of the world. So I would start with educational reforms, but also giving them some benefits in terms of getting into certain basic needs at a lower cost compared to what we are today.
Good question.
Thank you very much, Sienaka, for your thoughts. Shiran, concluding remarks from you before we wind up.
Yeah, just as you were saying, the interesting going to Canada, I think maybe Vancouver and Toronto will be like the next Melbourne at the rate you're hearing people want to migrate. But I think it's a fundamental question in terms of you see real, hope in the country, in the economy, and can your aspirations be met? I think it's two things. I think the civil conflict as well, I think we lost out on a lot of our demographic dividend because of a lot of people migrating. And I think we might, again, if the trend does continue and if we see some of those numbers coming in from anecdotal experiences of the people around us, I think that'll be a key loss for the economy. So what are some of these aspirations? I think, obviously a good job and all of that, but things like housing and even vehicles. And I think one thing that, for example, Singapore did was sort of take care of that burden and kind of give, free public housing and really, not free public housing, but at an affordable cost. I think it was 1990 leases and things like that that came into being, but really took that burden off the household and allowed them to kind of do things much better for themselves and aspire for other things as well. So I think things like housing, how can you make those kind of affordable? And of course, overall reassurance and I think more confidence in the economy, confidence of I think new jobs. So while we kind of expect those at a macro level, I think even at the industry levels and at companies, I think really looking after that talent and giving them opportunity to shine and drive businesses essentially, because I think there are new ideas that will really kind of take place and shape the future at the rate that technology and things like that are expanding. So it's a significant worry, and I think that might be kind of a key outcome on the pandemic when we look at this in 4 or 5 years, when we try to analyze what was kind of one of the biggest impacts of the pandemic.
All right. I believe that's all the time which we have for today. I want to thank our two panelists, Mr. Sena Kakiriwala-Godage and at the same time, Shiran Fernando, for spending your valuable time with us. And I believe the last 1 hour plus few minutes has definitely been one of the most insightful time slots of my week so far. And I'm also very happy to note that we had more than 120 active participants throughout the entire program, both on Zoom and on Facebook Live. And with our previous highest having been 70, I'm happy to the live audience number being 70. I'm happy to say that we kind of set a new PIM monthly montage record here. This goes on to show the level of confidence our participants have placed on both on you two gentlemen as well as on PIM as well. Thank you very much, dear panelists, for joining in, and also to our participants who joined the program on Zoom and on Facebook. That's it for this month's episode of the PIM Monthly Montage. I'm Tarun Amarasekara, and I will see you in October with the next episode of the PIM Monthly Montage. Have a great week ahead, and make sure that no matter what decisions you take, you do it with the right insight and intelligence. Thank you very much. And once again, dear panelists, Mr. Sena Kakiriwala-Godage and Mr. Shiran Fernando, thank you for joining us. It was a pleasure hosting you. On behalf of PIM, once again, thank you very much.